Across the United States, renters are beginning to notice a change that until recently seemed unlikely. After years of steady and often aggressive rent increases, the momentum is no longer moving in just one direction. In some cities, asking rents have stopped rising. In others, they are quietly falling. And in a growing number of markets, landlords are being forced to reconsider pricing strategies that once felt unquestionable. This shift is not dramatic. There are no nationwide announcements declaring the end of high rent. Instead, the change is subtle and uneven. Listings stay active longer than they used to. Price reductions appear where they were once rare. Incentives quietly return to markets that had completely abandoned them. For renters who have spent years absorbing higher costs with little room to maneuver, these signals stand out. For much of the past decade, rent increases were treated as inevitable. Rising housing costs were explained as the natural outcome of population growth, urban desirability, and limited supply. As wages lagged behind and everyday expenses climbed, renters adjusted because there were few alternatives. Housing was something people paid for first, often at the expense of savings, flexibility, and financial security. But affordability has limits. Those limits are not theoretical. They are felt month by month in household budgets. As food, transportation, insurance, healthcare, and utilities all became more expensive, the margin renters once relied on narrowed. Eventually, something has to give. In many cities, rent is where that pressure is now showing up. What we are seeing is not a collapse in the traditional sense. It is a slow fracture. Rent is beginning to break under the weight of cost of living pressure, not because demand disappeared, but because households can no longer stretch indefinitely. This process does not unfold everywhere at once. It appears first in places where rent growth accelerated faster than incomes, often during periods of rapid migration or investment. These early pressure points matter because rent behaves differently from other parts of the economy. Home prices adjust slowly. They are shaped by interest rates, lending standards, and long decision cycles. Rent, by contrast, responds directly to what people can afford right now. When rent growth slows or reverses, it is often a signal that household budgets are under strain, even if broader economic indicators still look stable. Today, we are looking at 10 U.S. cities where this pressure is becoming visible before it spreads more widely. Some of these cities are large and familiar. Others are smaller and more surprising. Each one tells a slightly different story, but together they reveal a common pattern. Rent rose faster than wages for years, supported by optimism, migration, and limited alternatives. Now, affordability is pushing back. In these cities, renters are behaving differently. Moves are delayed. Renewals are negotiated more carefully. Choices that once felt automatic are reconsidered. Landlords, in turn, are adjusting. Asking prices are reevaluated. Incentives return. Competition reappears in markets that had forgotten what it felt like. This does not mean rent is suddenly affordable or that prices will continue falling across the board. In many places, housing costs remain historically high. What has changed is the direction and pace. Rent increases are no longer guaranteed. Resistance has returned. By examining where this resistance appears first, we can better understand how cost of living pressure reshapes markets from the ground up. These cities do not predict the future on their own, but they show where strain is already present. They offer a glimpse into how affordability limits are being tested in real time, long before the story becomes obvious at a national level. Las Vegas is one of the clearest examples of how rent pressure shows up early when growth outpaces income. For years, the city benefited from a powerful mix of migration, tourism, and investment. During the pandemic period, Las Vegas attracted remote workers and new residents priced out of coastal markets. At the same time, investors moved aggressively into rental properties, assuming demand would remain strong and pricing power would hold. Rents climbed quickly, often far faster than wages in hospitality, retail, and service industries could comfortably support. For a while, the imbalance was easy to ignore. Listings were filled quickly, vacancies were low, and price increases were absorbed without much resistance. As long as new residents kept arriving, the pressure stayed hidden. That began to change as economic conditions shifted. New apartment supply came online just as demand cooled. At the same time, everyday expenses rose sharply. Food, transportation, insurance, and utilities all became more expensive, leaving renters with far less flexibility in their monthly budgets. Rent, which had already stretched affordability, became the breaking point. What renters in Las Vegas are noticing now is a change in momentum rather than a sudden drop. Listings stay active longer than they did even a year ago. Asking rents are adjusted quietly rather than raised automatically. Incentives that disappeared during the peak years have started to return. Landlords are competing again for tenants who are no longer willing or able to absorb higher prices without hesitation. On the landlord side, the shift is subtle but important. Pricing strategies are becoming more conservative. Vacancy risk matters again. The assumption that demand will always be there has weakened. Las Vegas has not lost its appeal, but the market is responding to the reality of household budgets. Las Vegas matters because it shows how quickly rent pressure can surface once affordability limits are reached. The city did not experience a dramatic collapse. Instead, it reached a point where renters could no longer stretch further, forcing the market to adjust. That pattern, rather than the headline numbers, is what makes Las Vegas an early signal. Austin, Texas became one of the fastest-moving rental markets in the country over a very short period of time. Fueled by technology expansion, population growth, and a strong reputation as a desirable place to live, the city absorbed wave after wave of new residents. Rent followed that growth aggressively. Asking prices climbed quickly as demand consistently outpaced supply, and for several years, increases were accepted as the cost of opportunity. What made Austin feel different was the sense that growth was permanent. Employers expanded, developers rushed to build, investors treated the city as a long-term bet rather than a cyclical one. Renters adjusted because alternatives were limited and momentum favored landlords. As long as jobs were plentiful and migration continued, the pressure remained manageable. That dynamic began to shift as conditions changed. A large number of new apartment units came online just as economic uncertainty increased. Hiring slowed in some of the sectors that had driven Austin's rapid expansion. At the same time, higher interest rates and rising everyday expenses began to reshape household budgets. Renters became more cautious, weighing housing costs against broader financial strain. What renters in Austin are noticing now is increased choice. Listings no longer disappear immediately. Asking rents are revised downward more often than they are raised. Concessions have returned quietly, offering flexibility that had vanished during the peak years. Lease renewals are negotiated rather than accepted automatically, signaling a clear change in leverage. From the landlord perspective, the market now requires active competition. Pricing power is no longer guaranteed. Vacancy risk has re-entered the equation, forcing more conservative strategies. Austin has not lost its appeal or economic base, but the assumption that rent could rise indefinitely has weakened. Austin matters because it shows how quickly a high-growth market can recalibrate once affordability limits are reached. The city did not experience a collapse. Instead, it encountered resistance. That resistance reflects a broader reality. Even in cities built on expansion and optimism, rent ultimately answers to what households can afford. Atlanta represents a slower, quieter path to the same pressure point that appeared more abruptly in other cities. For years, Atlanta was viewed as a relatively affordable major metro, especially compared with coastal markets. Strong job growth, expanding infrastructure, and a diverse economy allowed rent to rise steadily without triggering immediate concern. Increases felt incremental rather than extreme, and for a long time, renters absorbed them without much resistance. What made Atlanta's situation less obvious was the pace. Rent did not spike suddenly. Instead, it crept higher year after year, while other living costs rose alongside it. Transportation, utilities, insurance, and food expenses all increased, gradually narrowing the margin renters relied on. Individually, each increase felt manageable. Collectively, they reshaped household budgets. As affordability tightened, renter behavior began to change. Moves were delayed, renewals were approached more cautiously, Renters compared options rather than accepting increases as a given. In parts of the metro area that saw rapid development or heavy investor activity, listings began to remain active longer than before. Asking rents stopped climbing automatically, and in some cases, eased from recent highs. What renters in Atlanta are noticing now is a return of choice. The urgency that once defined the market has softened. Incentives appear more frequently. Price flexibility has returned in neighborhoods where competition among landlords has increased. The shift is not dramatic, but it is consistent. From the landlord perspective, the change is subtle but meaningful. Growth alone is no longer enough to justify higher prices. Vacancy risk matters again. Pricing strategies are adjusted with greater care, reflecting a market where renters are more sensitive to cost and less willing to stretch. Atlanta matters because it shows how affordability pressure can build gradually and then surface across a large, diversified metro. The city did not rely on a single industry or a surge of migration to drive rent growth. Yet even here, the limits of household budgets eventually asserted themselves. Atlanta illustrates that when wages and living costs fall out of alignment, rent becomes the place where resistance appears first. Denver is a city that, on the surface, still appears strong. Population growth has been steady, the local economy is relatively diversified, and demand for housing has remained resilient compared with many other markets. For years, those fundamentals supported consistent rent increases, and landlords came to expect that higher prices would be absorbed with little resistance. Rent growth became normalized as part of Denver's broader growth narrative. What complicates the picture is timing. In response to earlier demand, developers built aggressively. Thousands of new apartment units were delivered across the metro area, particularly in urban corridors and expanding neighborhoods. At the same time, broader economic conditions began to shift. Hiring slowed in some sectors, household confidence weakened, and renters became more cautious about long-term financial commitments. For a period, these changes overlapped without obvious consequences. Demand was still present, and vacancies remained manageable. But as more supply reached the market, the balance began to change. Renters suddenly had options. Properties that once leased quickly started to linger. Asking rents were no longer accepted automatically, especially as everyday expenses continued to rise. What renters in Denver are noticing now is a subtle but meaningful shift. Listings remain active longer than they did even a year ago. Incentives, such as free rent periods or reduced deposits, have quietly returned in certain segments of the market. Price adjustments are becoming more common, not as headline cuts, but as incremental revisions aimed at maintaining occupancy. From the landlord perspective, the environment now requires greater precision. Vacancy risk matters again. Pricing strategies are more conservative, and competition has increased among similar properties. The assumption that demand alone would carry rents higher has weakened in the face of affordability constraints. Denver matters because it illustrates how rent pressure can emerge even in markets that are not visibly distressed. The city has not experienced a collapse, nor has it lost its appeal. Instead, it has reached a point where supply, cost of living, and renter budgets intersect. That intersection forces adjustment. In Denver, rent did not fall because demand vanished. It slowed because affordability became the deciding factor. This makes the city an important signal. It shows how rent pressure can surface quietly, driven not by crisis, but by limits that households can no longer ignore. San Antonio illustrates how rent pressure can surface even in markets long considered stable and affordable. For years, the city was viewed as a lower-cost alternative within Texas, especially when compared with Austin or Dallas. Rent growth was steady rather than explosive, and the cost of living remained manageable for many households. That reputation created a sense of insulation, both for renters and landlords. What changed was not a single event, but the accumulation of everyday costs. Over the past several years, expenses tied to food, transportation, utilities, insurance, and healthcare all rose steadily. While rent increases in San Antonio were more modest than in some faster-growing cities, they arrived on top of an already tightening household budget. The margin renters once relied on began to disappear. For a time, this pressure remained hidden. Moves continued, leases were renewed, and the market appeared calm. But beneath the surface, renter behavior was shifting. Households became more reluctant to move if it meant higher costs. Downsizing became more common. Shared living arrangements increased quietly. These choices reduced turnover and changed demand dynamics in ways that took time to register. What renters in San Antonio are noticing now is a slowdown rather than a reversal. Rent increases are harder to justify. Listings stay active longer, especially in segments where pricing pushed beyond local wage growth. Incentives appear more frequently, signaling that landlords are working harder to secure tenants rather than relying on momentum. From the landlord perspective, expectations are being recalibrated. Pricing strategies have become more cautious. Vacancy risk is taken seriously again. Rather than testing higher rents automatically, landlords are responding to feedback from the market. The assumption that affordability would always hold has weakened. San Antonio matters because it shows how rent pressure spreads beyond headline cities. The market did not experience rapid growth or speculative surges. Instead, it reached an affordability limit through gradual erosion. When household budgets tighten enough, even modest rent increases encounter resistance. In San Antonio, rent did not break because the city changed. It adjusted because renters reached the edge of what they could absorb. That quiet adjustment is what makes the city a meaningful part of the broader pattern. Phoenix offers one of the clearest examples of how quickly rent pressure can build and then force a recalibration. During the pandemic period, the city experienced a surge of migration from higher-cost regions. New residents arrived looking for affordability, space, and lifestyle flexibility. Investors followed closely behind, moving aggressively into single-family rentals and apartment complexes. For a time, demand seemed limitless. Rents in Phoenix rose sharply and rapidly. In many cases, increases outpaced local wage growth by a wide margin. What made this growth feel sustainable was momentum. Units filled quickly, listings disappeared, and higher prices were accepted as the cost of entry. As long as population inflows continued, the pressure remained hidden. That balance began to shift as conditions normalized. Migration slowed, interest rates rose, and economic uncertainty crept into household decision-making. At the same time, everyday expenses increased, leaving renters with less room to absorb housing costs. Renters became more selective, and the urgency that once defined the market began to fade. What renters in Phoenix are noticing now is a clear change in pace. Listings stay active longer. Asking rents are adjusted more frequently. Incentives have returned in segments of the market that previously had no need for them. The market has not collapsed, but it has clearly lost its upward momentum. From the landlord perspective, the environment has become more competitive. Vacancy risk is once again a factor. Pricing strategies are less aggressive and more responsive to renter behavior. The assumption that demand alone would support continued rent increases has weakened as affordability constraints take hold. Phoenix matters because it demonstrates how vulnerable rapid growth markets can be when rent rises faster than income. The city did not lose its appeal or economic relevance. Instead, it reached an affordability ceiling. Once that ceiling was hit, adjustment followed quickly. In Phoenix, rent pressure emerged not because demand vanished, but because renters could no longer stretch their budgets further. That distinction is important. It shows how rent markets recalibrate when growth overshoots what households can realistically afford, making Phoenix a key signal in the broader national pattern. Minneapolis offers a different path to rent pressure, shaped less by migration surges and more by structural change. For years, the city maintained a relatively stable rental market compared with faster-growing metros. Rent increases were present, but they tended to be gradual, supported by steady employment in healthcare, education, and manufacturing. Affordability was not abundant, but it felt predictable. That stability began to shift as new housing supply entered the market and broader cost pressures intensified. Over recent years, Minneapolis added a meaningful number of new apartment units, particularly in multifamily developments. Policy changes and zoning adjustments encouraged denser housing, altering the balance between supply and demand in ways that took time to register. At the same time, household budgets were being squeezed from multiple directions. Rising costs tied to food, utilities, transportation, and healthcare reduced the flexibility renters once had. While wages increased modestly, they often failed to keep pace with the full cost of living. Rent did not rise dramatically, but it became more difficult to absorb. What renters in Minneapolis are noticing now is a return of choice. Listings remain available longer. Rent increases are negotiated rather than assumed. In some areas, asking rents have softened as landlords compete to maintain occupancy. The urgency that once defined the market has eased, replaced by a more measured pace. From the landlord perspective, the environment now requires adjustment. The presence of new supply means pricing must reflect renter sensitivity more closely. Vacancy risk is no longer abstract. Landlords are responding with more flexible terms, incentives, and conservative pricing strategies. The expectation that rent could rise steadily without resistance has weakened. Minneapolis matters because it shows how rent pressure can emerge even without speculative excess or dramatic growth. The city did not experience a boom fueled by investors or mass migration. Instead, affordability limits surface through gradual erosion. When supply increases and household budgets tighten simultaneously, rent becomes the point of recalibration. This makes Minneapolis an important part of the broader pattern. It demonstrates that rent pressure is not confined to high-growth or high-profile markets. Even cities built on stability and balance eventually confront affordability constraints. When those constraints are reached, the adjustment may be quiet, but it is no less meaningful. Columbus, Ohio is not a city that typically appears in national conversations about housing stress, which is precisely why it matters. For years, Columbus was seen as a dependable, low-volatility rental market. Anchored by education, healthcare, logistics, and government employment, the city offered steady growth without dramatic swings. Rent increases were gradual, and affordability, while tightening, remained within reach for many households. That reputation created a sense of security. Investors viewed Columbus as a safe bet. Renters assumed increases would remain manageable. Landlords expected steady absorption without much resistance. But as cost of living pressures accumulated, that balance began to shift. What changed was not rent alone, but the broader household equation. Food, transportation, insurance, and healthcare costs rose steadily, leaving less flexibility in monthly budgets. Wages increased modestly, but not enough to offset the full rise in expenses. Over time, renters began to feel boxed in. Moves that once felt routine became financial decisions that required more scrutiny. What renters in Columbus are noticing now is a change in tempo. Listings remain active longer than they did in previous years. Asking rents are met with hesitation rather than immediate acceptance. Lease renewals are negotiated more carefully, and price sensitivity has increased across multiple segments of the market. From the landlord perspective, expectations are being recalibrated. Vacancy risk is taken more seriously. Pricing strategies have become more conservative, particularly in areas that saw rapid development or investor activity. Incentives are appearing where they were once unnecessary, signaling that demand is no longer automatic. Columbus matters because it challenges the idea that rent pressure is confined to booming or speculative markets. The city did not experience a dramatic surge in migration or a wave of luxury development. Instead, affordability eroded quietly. When household budgets tightened enough, resistance appeared even in a market built on stability. In Columbus, rent pressure did not arrive suddenly. It accumulated. And once renters reached their limit, the market adjusted. That adjustment may not generate headlines, but it offers a clear signal. Affordability constraints do not need a crisis to assert themselves. They simply need time. Asheville, North Carolina illustrates how rent pressure can surface quickly in smaller, highly desirable cities. Known for its natural surroundings, tourism economy, and lifestyle appeal, Asheville attracted steady interest for years. During the remote work period, that interest intensified. New residents arrived from higher-cost regions, drawn by the promise of quality of life in a smaller market. Rents responded rapidly. Limited housing stock and strong demand pushed prices higher, often faster than local wages could support. For a time, the imbalance went largely unnoticed. Units filled quickly, and increases were accepted as the cost of living in a popular destination. The city's appeal masked the underlying affordability gap. That gap became harder to ignore as everyday costs rose. Food, utilities, transportation, and insurance expenses increased, leaving renters with less flexibility. Local wages did not keep pace with the combined cost of living. Renters began reassessing what they could realistically afford, and demand softened at the margin. What renters in Asheville are noticing now is a slowdown rather than a reversal. Listings remain active longer. Asking rents are adjusted more frequently. The urgency that once defined the market has eased, replaced by hesitation and comparison. Some renters are choosing to stay put rather than move and face higher prices. Others are looking beyond the city altogether. From the landlord perspective, the shift is subtle but meaningful. Pricing strategies are becoming more conservative. Vacancy risk matters again, especially in segments where rents pushed furthest beyond local income levels. Incentives are appearing in parts of the market where competition has increased. Asheville matters because it highlights how affordability limits assert themselves in smaller markets with strong appeal. The city did not rely on a single industry or speculative surge. Its pressure emerged from popularity combined with limited supply. When rent rises faster than local wages, even attractive destinations stall. In Asheville, rent pressure is not driven by economic collapse or loss of interest. It reflects a simple constraint. Households can only stretch so far. Once that limit is reached, the market adjusts quietly. That quiet adjustment makes Asheville an important signal in understanding how cost of living pressure reshapes rental markets beyond major metros. The Santa Maria and Santa Barbara region in California provides a final and telling example of how rent pressure emerges even in markets long associated with high housing costs. This coastal area has traditionally been supported by desirability, limited supply, and a steady inflow of residents willing to pay a premium for location and lifestyle. For years, those factors insulated rents from meaningful resistance. During the pandemic period, demand intensified. Remote work expanded the pool of potential renters, and limited housing stock pushed prices higher. Rent increases were absorbed largely because alternatives were scarce and expectations were already elevated. The market appeared resilient even as affordability narrowed. What changed was not the region's appeal, but the broader cost environment. As food, utilities, insurance, transportation, and healthcare expenses rose across California, household budgets became increasingly constrained. For many renters, housing costs began to crowd out other necessities. Even in a high-income region, the margin for absorbing higher rent grew thin. What renters in Santa Maria and Santa Barbara are noticing now is a subtle shift in leverage. Listings remain available longer than they once did. Asking rents are adjusted more carefully. In some cases, landlords are offering concessions to maintain occupancy. The pace of rent growth has slowed and, in certain segments, eased from recent highs. From the landlord perspective, expectations are being recalibrated. Vacancy risk has re-entered the equation. Pricing strategies are more cautious, reflecting a market where demand is no longer unconditional. The assumption that desirability alone could sustain rising rents has weakened in the face of affordability limits. This region matters because it demonstrates that no market is immune to cost of living pressure. Even areas with strong appeal and historically high rents eventually confront the same constraint. When housing costs consume too much of household income, demand softens regardless of location. In Santa Maria and Santa Barbara, rent did not decline because the region lost its attraction. It adjusted because renters reached the edge of what they could reasonably afford. That adjustment completes the broader pattern seen across all 10 cities. Rent pressure emerges where affordability breaks first, not where headlines are loudest. When these 10 cities are viewed together, a consistent pattern becomes clear. Rent pressure does not appear randomly, and it does not require a dramatic economic event to surface. It emerges where affordability reaches its limit, often quietly, long before broader indicators signal stress. Rent behaves differently from many other parts of the economy. Home prices adjust slowly, shaped by interest rates, financing conditions, and long decision cycles. Rent reflects something more immediate. It responds to what households can afford right now, month by month, after accounting for the full cost of living. When that balance breaks, rent is often the first place where resistance appears. Across these cities, the signs look remarkably similar. Listings stay active longer. Price increases are met with hesitation rather than acceptance. Incentives return in markets that once had no need for them. Landlords adjust expectations, not because demand has vanished, but because affordability has become the deciding factor. What makes this moment important is not that rent is falling everywhere, because it is not. In many of these markets, housing costs remain historically high. What has changed is momentum. Rent growth is no longer automatic. Pricing power has weakened. The assumption that households can always stretch further has begun to unravel. This shift does not point to a single outcome, and it does not predict what comes next. Instead, it reveals where strain already exists. It shows how rising living costs reshape behavior before the story becomes obvious at a national level. Renters adjust first. Markets follow. Understanding where this pressure appears early offers a clearer picture of how affordability limits work in practice. These cities are not warnings in isolation, but signals. They reflect the same underlying constraint playing out in different ways, shaped by local conditions but driven by the same reality. As economic conditions continue to evolve, rent will remain one of the most sensitive measures of household stress, not because it forecasts the future, but because it captures the present. It shows where people are already feeling the weight of rising costs and where the market is being forced to respond. That is what makes these cities worth watching, not for what they predict, but for what they already reveal.